Easy Peasy. I'm Crystal, the Community Manager at Prosperous. Let me introduce our speaker for today. We have Tim, Head of Content and Investment Lead at Prosperous, with over 10 years of content experience with the likes of Schroders, The Motley Fool, and CGS CIMB, covering everything from US stock markets to Asian equities and multi-asset. He's a passionate advocate of educating investors on the benefits of long-term investing and how to find the best in-class structural growth stories amid a fast-moving world. Tim is also a certified trainer for the SGX Academy. In his spare time, Tim enjoys running after his two young sons, playing football and practicing yoga. So without further ado, I'll pass the time over to Tim. Tim, over to you.
Hi, everyone. Thank you, Crystal, for the introduction. Thank you, everyone, for making time to come to this webinar on a Monday night. I know you guys will probably have very busy university lives. So I think part of this initiative that we're running at CGSCMB Securities is to really help people, approach investing in a more responsible manner, more long-term mindset, and really just starting earlier. The earlier you start, the better your returns are going to be over time, compounding. You've seen all the articles on all the data on that, so I don't need to regurgitate all that stuff. So what I'm going to do today is really just walk through really the basics. How do you start? How can you think about starting? Where can you look for ideas, in terms of asset classes, and how do you tap into those opportunities in today's investment world? Because you guys, your generation, have a lot of opportunity now at this day and age to really start young and get going. So without further ado, let me share my screen and we can get going. And then after this, or during this, anytime you have any questions, please pop them in to the YouTube question box there, and just ask questions whenever the urge strikes. So if you're curious about anything, please go ahead. Okay, so easy peasy, investing basics to get started. So before I begin, let me just go through the old disclaimer there that compliance wants me to have. And okay, so I'm going to start off by talking about the checklist. So even before you start investing, you've really got to think about your financial wellness and your financial state, and where you're thinking, where you are in your life. And if you're just starting out, if you're young, if you're still living with your parents, then maybe there are certain financial obligations you don't have yet. So maybe there's an opportunity for you to start. But I think for, most people going into the world and starting with their first job, and, maybe having an application to buy a HDB or to buy your own home in your 20s or mid-20s or late 20s, then there are certain obligations that you need to think about, right? So I think for me, I have a rule of 5 for investing, is that we should have certain things sorted in our lives before we start thinking about investing properly long term. So number one, have an emergency fund. I think if you're younger, you probably don't need 12 months. I think conservatively, that's 12 months of expenses, but preferably 6. But if you are, still living with your parents, or you're still under their roof and expenses are really paid for, then maybe it's an opportunity for you to start early, so you haven't got that necessary requirement to have that funds so young. Okay, number 2 is really a key one for me, is just don't borrow to invest. Don't take on debts. Don't leverage yourself and overextend yourself to make money in the short term, because I think investing, in my eyes, is more about making money over years and not really looking at market movements over a few days or weeks to try and make a profit, right? So I think even if you are into technicals and you do want to go that route with the trading, like, don't borrow, don't leverage yourself, really have an understanding of what you're getting into. For me, number 3 is more about the time and the patience, right? Think about holding whatever you're holding, whether it be an ETF or an individual stock, or even, whatever, cryptos or REITs. I think really think about holding it for a period of 5 years, thinking about the fundamentals and the patience, and to let that business grow. If you're buying into a business, think about the business as a business owner, and think about that over a period of 5 years or so, and longer, hopefully. Okay, number 4, accept that stock market volatility is normal, right? So it's not anything against the business if the stock price drops. It's not to say that this is a bad business, I shouldn't buy it, right? You're seeing that with the market right now. Lots of things drop all at the same time. So if the market is dropping, that doesn't necessarily mean that the business is doing terribly or is bad. It just maybe the environment it's operating in isn't great for the macro economy. But as a business over time, if it's a good business, then it should be able to recover and it should be fine. So just accept that the business and the stock price are not always linked. And so this is the difference that we have to accept as investors. And number 5, don't try to time the market, right? Don't think that you're going to be able to time the bottom and you're going to be able to sell at the top. Even if you do start to accumulate into a bear market, there's always the temptation to wait and then buy a big load when you think it's the bottom. But I think at the beginning, thinking about dollar cost averaging and averaging in is really a good first step to have before you start thinking about other avenues of investing. So I think these are the 5 that are a good foundation to start with and think about, and just to have that in your mind before you go out into the investing world and start your journey. Okay, so how do we start investing? How do you think about it from a young, your own personal view and how you guys are starting, because you're young but you have the interest to start, which is great. And I know the feeling of being lost. You don't know where to go, what to do. You may not even know what an ETF stands for, or you don't know what an index fund is or a mutual fund. And so there are lots of different asset classes out there that can be really confusing. And I think, part of the problem, I guess, is from our industry, we are not as good as we should be at trying to explain that to people and trying to make it as straightforward as possible. So that's what I'm trying to do here, is just make it simple, plain simple, for people just to understand how they can go about starting to build their wealth over the long term, and think about hopefully using investment to grow their wealth over the decades ahead. Okay, so I think first off, you should really have a plan, right? Stick to it, understand what are the different asset classes. And if you have a plan, and whether you're a trader, whether you're a long-term investor, and you understand that plan and you believe in that plan, you have faith in that plan, really be disciplined with it. There are lots of different assets, right? So I'm just going to run through quickly, individual stocks. Those are companies like, say, an Apple or Microsoft that trade on a listed market. You have exchange traded funds, ETFs, which trade that track an index or an overall market. You have mutual funds, which are unit trusts, as sort of run by professional managers. And then you have bonds and real estate, REITs, and crypto as well, right? So I think these are some of the asset classes that a lot of younger people are probably into or thinking about. And I'm going to go quickly through, the main points of each, and just kind of try and get people more familiar with the landscape that they're approaching in this day and age. Okay, so what is a stock? Okay, so for me, a stock, and I'm a big stock person. I love businesses and thinking about growth over long term. And so, a stock is really owning a real business and its cash flows. That's the key thing behind a business, is that it has cash flows, which means it has money, which it makes in revenue that flows down to profits. And obviously, when you're running a business, you have cash flows, whether that's operating cash flow or free cash flow. And so these businesses, at the end of the day, they're valued on these cash flows, and they're valued on their growth, right? Or earnings growth over time. And so these are listed on stock markets. They're traded daily. The biggest stock market in the world is the US. So that's where a lot of the value is in the stock market is in the US. And how can you gain from a stock? So basically, you have price growth, which is the appreciation of the price of the stock itself. And then you have dividends, which is the dividend yield. So if you own shares, companies that you own shares in will pay shareholders a dividend if they have profits in the form of a dividend per share. And so for each share, you'll get a certain amount. So that's a dividend, and that goes on top of the capital growth. And what you get from that is total returns, right? And total returns is really how you should view your returns in the stock market, is thinking about the growth and the dividends, and compounded over time. What does that equal? So I think that's the best way to think about the stock market. And finally, it requires patience and discipline in all facets of investing. Rather, I think that's true. Okay, so what is a blue chip stock? You hear this term bandied about quite a lot, blue chip, and it's cheap now, and so blue chip stocks are reliable businesses. They're mature businesses. They're businesses that are creating a lot of cash, and they are more established brands. And for most people, a blue chip stock pays a dividend. So if you think about the DBSs, the OCBCs, UOBs, the big banks here, Singtel, they're traditionally considered blue chip stocks. And what you would see in the US, you would think of Apple or Microsoft. They've become blue chip stocks because they're so reliable. And in other companies like Walmart or Johnson and Johnson, these big companies that have billions in revenue, that pay a dividend. They have a good track record. They're very reliable. They're sturdy, and they require patience and discipline to see that return over time. So for a lot of people, blue chip stocks, if you're more conservative, is probably what you might want to own if you start out with stocks. If you start out with individual stocks at some point, that's what would be probably the more conservative choices. They're more established, they're more reliable. Okay, so what are ETFs? ETFs, as you can see, have grown enormously over the past 20 years or so in terms of assets under management, which means the total size of the asset class, how much is managed in ETFs. And so ETFs as an asset class itself has really exploded over the past 20 years. And the great thing about ETFs is they give you access and diversification instantly by giving you ownership in a tiny piece of the business over 500 stocks or 1,000 stocks. It trades like a stock, so it's there as a passive investment vehicle. It tracks an index like the S&P 500, or it might track a local index like the Straits Times Index in Singapore. And so those are more passive investment vehicles where you don't really have to worry so much. It's just you put money in and it's tracking a whole load of companies in a specific market. And so popular ones would include the S&P 500, as I just mentioned, or the Straits Times Index, or if you're in Hong Kong, it might be the Hang Seng Index. So these types of ETFs give investors really, really great exposure to specific markets at a really low cost as well. I think that's a key thing. It's a very, very low cost instrument. And that's a key reason why it's also taken off. They've tended to outperform a lot of managed funds, actively managed funds in the US at least. And the data on that has been overwhelming. So it's taken off in terms of popularity with a lot of investors who maybe don't want to actively manage their portfolio or give it to a fund manager to manage. So they manage it themselves just via ETFs. Okay, so mutual funds, unit trusts, which I just touched on just now previously about professional fund managers, which is, they really are employed by big giants like BlackRock or JP Morgan. And these guys sell a lot of funds that are managed by investment professionals. And so what they do is they will tend to track their performance against the benchmark. Say they're a US fund, they will most likely track their performance against the S&P 500 if they're a US large market cap weighted fund. And hopefully they outperform, right? So as I was saying, a lot of funds don't in the US, they don't tend to outperform over the long term, which is why ETFs have taken off. It's more of an active approach. So active is really not following the index and trying to deviate from that index and trying to pick stocks and effectively outperform the index over the long term. And so it's more of a pick or a conviction on the manager and his team and the person or her team that is running the fund to really think about outperforming the ETF, because at the end of the day, you want to outperform the market, and that's the key for these professional fund managers. But again, there's some great funds and unit trusts out there, but they have to be identified, and they require patience and discipline as well. Okay, and what are REITs? William Defoe can tell us. So basically, real estate investment trusts, they will give you exposure to physical real estate. So if you think about buying a property in Singapore, if it's something for an investment, say you own your HDB already, or you own your private condo already, and then you want to own something else, you might have to buy, when you put down money for a piece of property, a physical residential property, it costs a lot of money, right? It might be a few $100,000, it might be over $1 million. but the deposit for that is going to be humongous. So you have to have a lot of capital, and then you have to take out a mortgage. And so effectively what REITs gives you is really a low cost, flexible way of accessing a portfolio of properties that are managed by a professional manager, a professional real estate manager. So if you think about Singapore and perhaps different verticals of real estate, different asset classes, or different areas, sectors of subsectors of real estate, maybe industrial. There are some big industrial REITs here that have, over 50 or 100 properties. And so they take rents from those, and what they then do is pay out those profits and the revenue that they generate from the rents to you as a unit holder. And so it's more of a way for you to get a regular income and to have exposure to the real estate asset class as well. And the great thing about Singapore is that there's no dividend tax in the US, in Singapore rather. I mean, the US, they always complain about how there's dividends are taxed at 20% or 25%. In Singapore, there's zero tax. So you get all of that back, right? So if you own a property and you get rental income, that is taxed. But if you own a REIT and you get the dividend, none of that is taxed. So I think that's one of the big key attractions for owning REITs for Singaporeans, and for actually for investors in other places in Asia, like Hong Kong, where there's also no tax. So trading stock, it trades like a stock. It's highly liquid. It offers diversification. If you need the cash, you can get it out very quickly. Unlike if you own a physical property, you have to go through the time to sell it, to get the surveyors, to get the lawyers to draw up the papers. So that takes a lot of time to get your cash. Whereas with a REIT, it's very liquid, and it's very easy to access your funds if you want to. Okay, so this comes down to DCA. So DCA, which is dollar cost averaging. So for people who may not be familiar, I'll just explain. Dollar cost averaging is essentially just taking a small amount of money every month or every 2 weeks or whatever period of time you would like to do it, and to put money into the market, whether that's into an ETF or a stock or a fund, whatever your choice is. And lump sum investing is taking a big amount of money and investing it all at once, at a specific period in time. And so there are lots of proponents for each. Lots of people who say lump sum investing is better, and there's lots of people that say DCA is the preferable choice. I think you can DCA regularly, as you've seen here in the chart. One of the worst decades on record for stocks was 2000 to 2009 in the US, at least. And so, if you actually DCA'd during that whole period, you would have, if you DCA'd from the beginning of the tech bubble, you would have come out on top versus going into in terms of lump sum investing, right? So it's key to understand where you're, like, when you're buying, I guess, is the key. But I think investing into a bear market helps you to have more of a regularity to investing. And if you're buying when prices are lower, that's great, right? So imagine if you had bought at the peak of 2000, as you can see in this chart, it goes down very quickly, the value of that investment. Whereas with your DCA, it's a bit less pronounced. But in 2009, 2008 rather, for the financial crisis, obviously that plunges again. But over the decade, DCAing actually comes out on top, which is great. But you can invest with a lump sum approach when opportunities arise. This is an example from 2009, post the crash in the global financial crisis, to more recently, and I think this closed out in 2018-19. But as you can see, we've had a great decade or so for stocks. And if you invested at the bottom when everything looked terrible, if you'd invested a massive lump sum, you would have done very, very well. But I think there's opportunity to do both. You don't have to do one or the other, but just be aware of the pitfalls, I think, of each one. So you just have to manage your cash flows, manage your expectations, and put cash to work when you're comfortable. I think it's important to always think about taking bad times in the market and making some opportunity out of that. I think it's the best time to think about investing when the markets aren't doing so well. Actually, you're as I said the other night at an event for some students at our office, I think you're starting at a good time when sentiment's pretty bad actually right now in the market, and that's the best time to be starting or thinking about starting your investing journey, because you don't want things to be so expensive when you start, right? You want it to be going down, and then over time that will recover, and it should because the market will recover, as I just mentioned. This is over a period of 80 years, and this is why the US is the biggest, and it's got the best track record. It's got very, very robust companies. And over the long term, it's survived however many world wars. It's also survived the Great Depression. It's survived multiple financial crises. It's survived hyperinflation in the 70s. So I think for long-term investors, if you think about just putting your money into stocks or to ETFs or into the market, eventually over the long term, you will come out on top. And try to avoid doing this, when you start your journey. I think thinking about selling as soon as things drop or getting really, really scared out of the market is one of the biggest mistakes I think a lot of us have when we start. Is we get really, really scared that big drops in the market means we have to sell. But as soon as you start selling things, whether that's ETFs or stocks, or that's then become a loss, right? That's a real loss. Whereas if it goes down 5% or 10%, that's a loss on paper, but that isn't being realized, right? So when you realize that loss, that's you can't take that back. It's gone. So I think it's thinking long term about it, thinking about investing with a mindset of 5 years, 8 years, 10 years, thinking about where that's going to take you in your financial journey. And if you're thinking about the market falling further, and you've got really good conviction on specific companies, or you've got an ETF that you like and it will come back, then that's something that you need to think about, maybe putting in more DCAing into it, or thinking about adding to that position as well, and using the crisis as an opportunity. Okay, so portfolio inspiration. I've just got a few ideas from the top level to think about for students out there. ETFs, as I said, are a great way to start. I think for most of you, you'll be familiar with tech. And so the biggest tech companies are in the US, and the biggest tech index is the NASDAQ. And that is a index of the 100 of the biggest tech companies listed in the US. And so if you're thinking about the NASDAQ, the most popular one is the QQQ, which is the Invesco ETF that tracks the NASDAQ index. If you're thinking about broader market exposure, you can look at a Vanguard Total Stock Market Index ETF, which looks at sort of 4,000, 5,000 companies across all different ranges of market cap in the US. So it's a very broad index, which captures the economy a lot better. If you're thinking about the S&P 500, which is the 500 biggest companies in the US, there are loads of great options, and they're also cheap. I mean, they're ranging from three basis points, which is 0.03% as an expense ratio, which means the cost, versus, I think the SPY, which is the State Street one, goes up to 0.09%. So if you think about management funds like mutual trusts or unit trusts, they will charge maybe 1.5% to 2% annually. And you're looking at ETFs that can charge as low as 0.03 or 0.09, right? So I think for mutual funds, they always have to perform and outperform very strongly, because the fees tend to eat away at that outperformance if they're over time. So low cost index ETFs I think are great for beginners. If you're thinking about China, there's iShares China, which looks at MSCI China A, which is an onshore ETF. So it's onshore equities. There's stocks listed in Shanghai and Shenzhen, which is a bit more of a closed market, but it's also, if you want exposure to China, I think that's a great way to go down that route. And if you're looking at international stocks outside of the US, then there's a international stock ETF as well that is VXUS, which you can access relatively easily. So ETFs, I think, as I said, great way to start, and always easy for people to sort of kick off their investing journey, because you're being diversified immediately. Okay, so I think this is a quick touch on ETFs, REITs, and in Singapore we have business trusts as well, which is a really key part of the landscape here, because there are quite a few business trusts. A few weeks ago we did a webinar with Netlink, which is a business trust in Singapore. They own a lot of the fiber broadband, or majority of the fiber broadband in Singapore. And so they're a really key utility player, but they're very stable business. So they're a business trust. So what are business trusts? What are ETFs? What are REITs? So I think for ETFs, as I just mentioned, they are tracking a specific index or a specific market profile, but try to avoid the really synthetic and exotic ones. There are things that are leveraged. So there are synthetic ones. There are inverse ETFs. So it's like you're betting on the market to go down if you want your ETF to go up. And so there are lots of different variations of ETFs, but the plain vanilla ETF, which is basically a straightforward equity ETF that owns the specific stakes in these companies that they track, that's what you should be looking at to start, because some of these, they don't even own the underlying assets, right? So you've got to really understand what you're investing in, what it holds, and make sure you're not buying into something that is perhaps being marketed as something that it's not. On the REIT side, I think it's important that you guys understand that REITs, they have to pay out 90% of their income that they get in dividends, right? So that's a key part of it, which is why they're such a big income generating investment in Singapore and globally. And in Singapore, at least, they're limited to taking on gearing of 50%, right? So net debt to capital cannot be over 50%. Business trusts, they have a trustee manager that owns and manages the assets, but they're the same person. Whereas in REITs, they have different trustees and a different asset manager. And business trusts, they have no limits on borrowing. They can borrow as much as they want to. And they also have no requirement to pay out dividends. So in terms of the certainty, maybe there's less certainty in terms of the actual income stream, but they can leverage themselves more as a business to grow more if they think that's appropriate. So there are different constraints and different specifications for each of these things that you need to be aware of in Singapore, at least. Okay. All right. Gonna move on. Oopsie, sorry. There we go. So I think it froze there for a minute. Okay, so I think I'm just going to end on asset allocation, right? Before I finish up and before we start taking questions. Asset allocation is really key, right? You know, the risk profiles for everybody is going to differ. So someone who's starting out, if you're 17, 18, 19, your risk profile is going to be vastly, vastly different to someone who is 60 or 65, mainly because of your time horizon, right? You have a time horizon that is longer. That means you can be a bit more risk forward with your portfolio. And so it also depends on your personal profile. Do you want to be someone who owns, a lot of bonds, or do you want to be someone who owns a lot of stocks? But as an example here, we have a diversified portfolio. This is taking a US example. You can probably equate domestic and foreign and think about that in Singapore or US terms. But if you're thinking about the US, it's much more growth oriented. There is some income there. But if you're thinking about Singapore, it's much more sort of the physical, the real estate in terms of REITs, and then also the income plays such as banks and telcos and that sort of thing. So there's much more mature businesses in Singapore. There's not to say there's not mature businesses in the US, there are, but it's much more a destination for international investors as a growth center, because there's so many innovative companies and like high growth companies there in that sector, in that country, especially in technology, right? As we've seen. Bonds, they've had a great run for the past 40 years, but there are questions about whether they diversify our portfolios for us as much as we would hope versus stocks. And then REITs, should be considered really a different asset class, because they don't really have the same characteristics as a stock, even though they're listed. They take on debt, but they own properties, so they own physical real estate, and that asset class can perform well in times of inflation, and as we're seeing recently in high inflation environment. So they have different correlations versus maybe the traditional stocks that you would see. So there are lots of different examples. And commodities, another example, commodities players, whether that's stocks or owning a commodities fund, for example, a commodities ETF, there's always an argument for diversifying into that as well. So I think it's much more on your personal risk level, what you want to do and what you're comfortable doing. Obviously, the general rule is if you're younger, you want to take on more. And I think it's important, let me say before I go further, that risk and volatility are different, right? Risk can be, it can be thought of as you think that this name is very volatile because it goes up and down a lot, right? But I think risk is more about understanding what your appetite is for how volatility affects it, right? So volatility, sometimes it will go, a stock can drop 20%. Sometimes it can go up 20%. That's volatile. But if you're thinking about a risky company, that could be something that is this business model is being disrupted, or it's not paying out as much as it should be in terms of dividends, and so maybe it's a trap in some sort of way. So I think risk and volatility need to be assessed in different ways, but you have to be comfortable with what you own. You have to be comfortable with your financial plan, and you have to be aware of each asset class and what it can add to your portfolio before you start building it out and then thinking about it. But it's important to understand asset allocation, because across sectors, across geographies, if you own a lot of stocks, it's important to be diversified across sectors and countries, and your home country, and probably the US and other regions as well. And it's the same with any other of the asset classes. It's important to know what you own and be fully diversified in that sense. Okay, so I think that was my quick half-hour introduction. I did it in just under half an hour, which I'm pretty pleased about. So I will start taking questions, I think. Yeah, we can do the Q&A. First off, I think maybe let me stop my sharing so that I can answer these questions fully here. Okay, so maybe I should go through the questions first off. Okay. All right. Okay, so I think we have a question here. So it says, how should I think about investing in, should I start investing in the US or in Singapore first? Well, I think it's, yeah, let me, I guess I did touch on that during the presentation. I think it's important to think about where you want your portfolio to go and where you're more comfortable with investing. I think if you're looking at an ETF, it might make sense to buy an ETF in the US because that's the most, I guess, longer term data driven. It's got the best performance in terms of looking at it over the long term. But if you wanted to maybe start buying a share or buying a business that you're more familiar with in Singapore, one of a blue chip stock, as I just touched on earlier, then maybe Singapore is a better option because it gives you the opportunity to think, to dip your toes in the water, understand the business, what it does, how it can grow, but also it's not as volatile maybe as it might be in the US, a business in the US. And as long as the business here is strong, and there's a lot of great, strong businesses in Singapore that are very reliable, then I think Singapore can be a good opportunity to start with a blue chip stock. And maybe in the ETF space, you can start in the US. So it's always important to sort of think about your comfort level with Singapore companies and then your comfort level with US companies. But because we're obviously not based in the US, maybe we won't be as familiar, which is understandable because we don't interact with brands every day that US investors might have access to. So from that perspective, we might be comfortable, but it's important, even though you are familiar with brands here, to understand what they do, understand the business, understand what is moving them forward, and invest accordingly and responsibly according to that. Okay, I've got another question. Okay, so what did I mean by REITs offering diversification? Okay, so REITs offering diversification, what did I mean by that? Well, in terms of bear markets over the past sort of 50 years or so, there's been a lot of talk recently about REITs being a good asset class to own in times of inflation. And Singapore is obviously a very, very big hub for REITs here. But if you're thinking about the Singapore REIT market, is actually relatively young. So the first REIT here was listed in 2002. So it's the 20th anniversary. In 2002, Capital Land Malls Trust, CMT, listed, but it's now become Capital Land Commercial Integrated Trust. So Capital Land Mall Trust, when they listed back then, they're the owners of what is now Funan and Plaza Singapore and a lot of other big malls that we're familiar with. And so there's a very young market in Singapore. So the data for understanding periods of high inflation, obviously it doesn't go back because we only had the first REIT in 2002. So if you look at the US, which is the data set for REITs, that is really key because the US REIT market has been around since the 1960s. So it has a much wider breadth of data for us to assess over 60 years or so. And so in that market, REITs as an asset class outperformed stocks, during a big part of the 70s when stocks were falling. They produced positive total returns annualized. They produced positive total returns in the early sort of 80s as well, when there was high inflation and high interest rates. And then they also posted positive total returns during a recession and higher inflation in the late 80s, early 90s for a period of maybe 2-3 years. So I think in terms of looking at the data set and looking at the history, like REITs offer that diversification from a perspective of you're owning real property, physical property, or owning a piece of it. And in times of high demand for certain things, or people flee to real assets like physical real estate or infrastructure or utilities, things that own real assets, alternative assets that can generate income, and REITs are one of those, right? So REITs, in terms of diversification, they diversify away from businesses and stocks in that they don't own real assets. There is a lot of intangibles, for example, for Microsoft. They own a lot of software and patents and like IP, intellectual property, right? But they don't own physical properties, and a large part of their value doesn't get derived from physical goods. So I think that's the key that I was trying to make, is that REITs offer some diversification in terms of owning physical property, and in times of certain periods of macro some characteristics like inflation or higher interest rates, REITs historically have done relatively well compared to other asset classes. So that's something that I meant by diversification. Hopefully that answered the question. Okay, next question is, how does dollar cost averaging work? Okay, yeah, so dollar cost averaging, as I said, is basically just say you get paid on the 15th of every month or the 1st of every month or whatever day, and you maybe get paid, I don't know, $3,000. Maybe you want to put 10% of that into the market. So you put $300 and you manage your expectations in terms of your cash, right? So say you get 3,000 and then you put 300 every time you get paid into the stock market or into the market in general or into a stock. That would be doing it every month very consistently on the 1st or the 15th or whatever day you get paid, or the next day, and doing it on the same day every month for a year or 2 years, 5 years. So that is dollar cost averaging, is basically taking a set amount of money and then doing it every month so that you're buying at a different price each month, because obviously after every month it'll be at a different point on its trajectory, and you'll be able to buy more maybe when it's down, and then obviously when it goes up you won't be able to buy as many more units, but you're still using the same amount of money to try and invest into the market. So that is effectively how dollar cost averaging works. Sorry, let me just have a drink here. What do you think of the long-term prospects of investing in China? There seems to be lots of restrictions for innovations as well as regimentation from the government. Okay. Sorry. Okay, let me just repeat that again. Okay, so what do you think of the long-term prospects of investing in China? There seems to be a lot of restrictions for innovation as well as the regimentation, or I guess the regime or the business regime from the government. Yeah, so my own personal opinion is I think it's over the past couple of years, it's been a very difficult environment for investors looking at China. So I think it's more about whether you want to be a part of that growth story and you think there is growth there, I think for a lot of investors, it's difficult because as the question points out, right, there's a lot of restrictions and the government likes to be involved a lot in business in China. And in terms of the returns, doesn't tend to be great for your returns because there is going to be an agenda for the government and there's going to be an agenda for shareholders, right? And those two don't always match. So if the government wants something, maybe they will tell the company to align their business with that goal of the government, and that goal of the business, or sorry, that goal that the government wants the business to work towards, it may not really be the place that generates profits or shareholder value for you as an investor. So I think that's something that you'll just need to be aware of when you invest, if you do go into China, that these things there are restrictions, as the question pointed out. And if you think about the long-term data of actual historical returns in China, if you think about the MSCI China, which is a large benchmark tracking Chinese stocks, either listed in Hong Kong from the mid 90s when they started listing. So China really opened up, early 90s. There were some companies that started listing in the mid 90s in Hong Kong, so Chinese stocks. And so if you think about the 27 year period since they started listing, it's a very short history, right, for Chinese stocks, because it's such a new concept, I guess, for China, for stocks, for stock trading. And so if you look at that performance, they've given a total return of about 3% or 2.9% over the past 27 years, right? If you look at US stocks, it's delivered about 10.9% over 27 years annualized. So if you look at the data, you might have been better off putting your money into treasuries, like US treasuries, which is effectively a risk-free asset, versus buying the Chinese market. So, there's a lot of excitement about it. There's an argument to be made for being active in the Chinese stock market, because the actual market itself has been so terrible over the past 27 years if you've been a long-term investor. So I think it's more about your comfort level investing in these Chinese companies, but knowing that they will maybe have to align with the government and not really what the business could be doing or should be doing. And you just have to accept that the government will be part of the investing landscape. So for a lot of people, it's really not worth it, and it's quite more of a headache. And I'm probably in that class. It's quite a headache to think about that in politics when you invest, because you already have enough to worry about. For example, the competitive landscape and all these other things, without throwing in politics. So for me, politics is more of a headache to think about. So I think that's something you have to be okay with in China. But there are lots of if you are okay with it and you see a lot of opportunity, then that's great. But obviously you need to measure your the performance of that stock or ETF or asset class when you go forward, and make sure it's performing to your expectations. Hopefully that answers that. Okay, what is the difference between longing a stock and shorting a stock? Okay, that's a great question. So the difference between going long a stock and going short a stock. Okay, so going long a stock basically means that you are buying it and holding it and believe it's going to do well, right? It means that you think the share price will go up in value over time, or it will go up in value over whatever period you hold that stock. It effectively just means you're bullish and you're positive on that stock, and you hold it to buy it, or whether you recommend it, you're going long. It means that you think it's a good stock to hold for investors. Going short a stock means that you think that this stock is going to go down in price. And so when people short, or when traders short, what they do is they basically they buy the shares, or they basically buy the shares at a higher price, and then they lend them out effectively right after that. But they will need to buy back the shares when after a certain period of time. So what they do is they hope the price goes down, and then they buy back the shares at a lower price after that has happened. So what they do is they get the spread in between the share price that they had bought at and the share price that they had to repay at, which is a lot lower, hopefully, for them. So shorting a stock is more dangerous, because you don't necessarily you're betting on short-term movements, and you have to understand the leverage you're taking on, and your margins and stuff. So that's more of a strategy that a lot of hedge funds use. If you hear of hedge funds, these are funds that will charge a big management fee, but they are very active. So they do a lot of long and short. So a big strategy is long short, which looks at going long certain stocks and going short on a certain amount of stocks as well. So that is a process that is more trading oriented in the short side. If you're just talking about investors, just everyday investors and thinking about long-term investing, it's more going long, right? That's effectively what it means is being bullish on it. And going short is betting on the share price to go down. Okay, so what are bonds, and are mutual funds the same as hedge funds? Okay, yeah, that's a good question. So bonds and are mutual funds the same as hedge funds? Okay, so bonds are basically, effectively, they are debt, right? They're a form of debt. So if companies want to raise money, or if governments want to raise money, they'll issue a bond. And to be able to get money from the public or get money from investors, they'll have to pay out a coupon, right? And a coupon effectively is it's kind of like a dividend. They have, they pay it out, but unlike a dividend, they're obligated to pay that out to the bondholders. And so, for example, you hear a lot in the financial press about U.S. treasuries and U.S. bonds. And so what they are is, they're a form of a bond, but they're considered like a risk-free bond because it's backed by the U.S. government, which is so big, and effectively the market thinks it won't ever go bust. So it depends on your coupon rate or how much you get to charge as a company. It depends on how credit worthy, the market thinks you are. So if you're a very young startup and you've got 100,000 in revenue, your coupon rate, if you try to issue a bond, is going to be humongous, right? Versus if Microsoft or Amazon or Apple wants to issue a bond, they will be able to get a much better rate for their coupon for raising debt at that level. So bonds pay out coupons, and they tend to pay out coupons every 6 months. If you're Singapore and you're thinking about buying a bond, there's a lot of, the bond market is very big in Singapore. You can buy, as a investor, you can buy Singapore's securities savings bonds. You can buy Singapore savings bonds, but they're guaranteed. And so the principal, which is what you buy at, that can fluctuate, right, according to the bond price in the markets. But I will say that bond markets are not very liquid, which means they're not easily tradable. So the bond market is usually consumed by professional investors and institutions that provide a lot of liquidity for the markets, right? So if you want to buy a bond as an individual, you might have to pay 500,000, or it might be a minimum, right, to buy that bond. But they have ETFs that can serve that function for you. So you can go do that if you want to get a bond. But a bond is really a much more conservative investment. It's much more lower yielding. It's considered safer. So it serves a function, but the bond market is absolutely humongous. I think it's much bigger than the equity market. So it does move a lot of money around. There's a lot of money in it, but it's because a lot of the governments and big companies, they issue a lot of bonds. The US government, Singapore government, all governments basically. So there's a massive government bond market, which is sovereign. It's called the sovereign bond market. And then there's a corporate debt market, corporate bonds, which is, companies that you'd be familiar with issuing bonds as well. So bonds are effectively a way for companies to raise money by issuing debt. It's a form of debt at the end of the day. Second question on mutual funds. Are mutual funds and hedge funds the same thing? So no, they're not. So mutual funds are what you would see being plastered around, any place in the CBD or elsewhere about, a big fund provider like a JP Morgan or a Schroders talking about Singapore equity or Singapore equity yield or Asian yield, some sort of fund that owns a basket of stocks, and they're actively picked by an investment team, and they're managed by a team of investment professionals, and they make recommendations to the fund manager, and the fund manager will sort of manage that basket of assets, of stocks, and it's really mass market, right? It's promoted to you and me, to everyday investors who can buy it via their banks or buy it via the bank channels. They'll be able to talk to a financial advisor, or they'll be able to buy it in a fund supermarket, online fund supermarket, for example. And there's lots of information, and it's very easily accessible, right? So that's what a mutual fund is. It's a unit trust. It's also called a unit trust. A hedge fund, on the other hand, is really more reserved for people who are maybe high net worth individuals who want to take on a bit more risk and have a lot of capital to deploy. Hedge funds will usually take on a minimum. They might not be, it's not accessible at all to most retail investors unless you have a lot of money. So that's more ultra high net worth individuals. Some institutions like pension funds that want some hedge fund exposure, they will do that. They will put money towards hedge funds. And the reason is hedge funds are, they take on a lot more risk and they deviate a lot more from the benchmarks. And as I just mentioned, they do a lot of shorting as well of stocks. They'll go long some stocks, but they'll short other stocks as well. So the expectations are a lot more different, and the fee structure is a lot more different. It's a lot more expensive for investors to invest into hedge funds. The fee structure that they take and the profit that they take is a lot higher than the fees from a mutual fund, because mutual fund is much more aimed for the mass market retail investors. So hopefully that answers your question on that. Okay, I've got a couple more questions. Okay, so what do you think of the Fed remaining hawkish in the coming months? Should inflation continue to decline? Okay, so this is a macro question, and I think that the moment of the day is it's all macro right now. And so our chief investment strategist, Seboon, is a very, very smart guy. He's talked about the Fed remaining hawkish to crush inflation. So for me, I would have to agree with him and align with him, because if you think about the history of the Fed, as someone who participates in the stock market, you want the Fed to be responsible fiscally and to manage the economy properly. If you start to see inflation coming down, I don't think it's going to be any reason to get super excited, because it came down last month, I think, from 8.9 or just over 9 to like 8.7 or 6. I mean, it was a bit lower than expected, but it was still above 8%, right? And so if you think about the target that the Fed looks at, the target is 2%. So 2% and 8%. So it's still extremely high. So the Fed is going to have to tighten continuously for a while before we start to even see it coming back down towards the range that they would be comfortable with. So in that sense, there was a lot of excitement when there was the market rally in sort of July and August, coming into August, and we've seen that reverse. So I think it's important to understand the context, the history. In the 70s, we had a Fed governor named Arthur Burns, and there was massive inflation in the 70s. And every time the Fed in the 70s started to ease, they started to ease when inflation started to come down. And then what happened? Inflation went back up. And so they had a massive issue structurally with inflation in that decade. And it only really got dealt with in the 1980s when there was a Fed governor by the name of Paul Volcker who came into power. And what he did then was he just raised rates vigorously and persistently, and it hit a high of about 19% in the early 80s. Hopefully, fingers crossed, we don't have to go through that this time. But he basically crushed inflation. And so what he's remembered for by the stock market and by investors is really for crushing inflation and for allowing the stock market to kind of recover and get back into its growth mode. Whereas in the 70s, Arthur Burns, unfortunately, is remembered for not really crushing it and not doing it. So if you look at Jerome Powell's comments from the Fed, he is looking a lot more along the lines of, I don't want to be Arthur Burns, and we need to make sure inflation is back down to the rate that we want it to be. And so I don't think of 10-15% will worry him in terms of the fall of the market. I think that's part of the process he's probably thinking. And I expect there to be a 75 basis point hike this month, and at least 50 going forward for the next couple months. Let's see. But I think the resolve is there for the Fed, and I don't really see them backing down. So I think the hawkish sentiment will continue in the months ahead, even though inflation may come down further a bit. You'd have to see a sustained fall, and for it to fall, close to the 2% range that they want. So yeah, that's how I would see the Fed, at least in the next sort of 3 to 4 months. Okay, another question. If we are bearish on the IXIC in the short term, do you think it is reasonable to hold SQQQ to increase our returns? Okay. Okay, so if you're going to be short, sorry, you're thinking you want to be short the QQQ. I assume, like, let me be a bit more familiar with this, right? Because I'm not a shorter, so yeah. So you want to go short the Nasdaq, right? I'm not a trader, so I'm not going to be betting on short-term movements. I think the technicals, there will be periods of time for you to go into the technicals if you want to. I think if you are bearish, it's your choice if you want to short, and if you think that shorting is going to increase your returns. I personally don't like to short. It's just not something. It's like too stressful for me, and it's like I'm not that interested in it, to be honest. And if you think about long-term returns as well, shorting, unless you take on massive leverage, the most you're ever going to make is like 100% because it has to go to zero. So you can make like 20%, maybe 10%. That's exciting, maybe for some people, and that's cool. But I think for me, I'm more excited by the fact that if you hold a stock for maybe like 10 years, 12 years, 15 years, you can make, if it's a good stock or if it's a good company, you can see the returns be 1,000%, 1,200%, 1,500%, whatever. So it's, a stock's ceiling is not 100%, and you don't have to take on massive debt to magnify it. But I'm speaking from that perspective in a bear market right now, right? So that's the way it is. But if you really think it's going to be bearish, that go for it. But I think you really need to be understanding the risk that you're going to be taking on and understanding where the market is going. So there's lots of market forecasters out there. We like to talk about it, or like to say, but at the end of the day, the price action is going to be no one knows where the price action is going to be in the short term, or in the medium term. It's very, very difficult to see. But if you think about the long term and where the trend is, obviously it's gonna be up, on the whole, up and to the right. So yeah, I mean, I'm not a fan of shorting. I'm not a fan of taking on leverage. As I said in the presentation, I think leverage is dangerous unless you know what you're doing, and you have to be extremely cognizant of the risk. And I think the traders will probably agree with it. Is you need to have a risk management plan, and you need to know what your risk boundaries are, and be comfortable with that as well. Okay, so a couple more questions. I'm getting a lot more now. Okay, I've got one more with types of stocks. Okay, so what types of stocks would you recommend for trading? Okay, so I'm not a trader, but if you're thinking about the types of stocks that are very volatile, technology is obviously in there as a very volatile sector. I wouldn't be comfortable giving you individual stocks because I don't trade on momentum, or I don't trade on technicals. But there are chartists in our firm who are very, very happy to talk about that. And I think we have someone who will be doing a presentation in the next couple of weeks on charting and technicals. So I think that's more of a question for that person to talk about trading and to talk about short-term movements of stocks. Okay, so what are fractional shares, and is that available for all types of assets? Okay, yeah, so that's a good question. Fractional shares is the ability to, so say in the US, you have to own, you don't have to own, rather, you normally buy one share, right? So if you buy a company, you normally buy one single share, and that may set you back quite a bit, because if you think about before Tesla split its stock, effectively Tesla, maybe about 12 months ago, or 15 months ago, Tesla cost maybe in the range of $1,000 a share. And same with Amazon. Amazon, before it split its stock, it cost about $3,000 per share. So to own that one stock, you had to pay $3,000. For Amazon, and maybe for Tesla, you'd have to pay $1,000. So that's a big amount of money for a lot of people, right? So if you think about fractional, what fractional allows you to do is to put a dollar amount and buy a fraction of that share. So if you were looking at Tesla at $1,000, you could buy 0.1 shares of Tesla, but you would only have to put in $100. So the market over the past sort of 5-6 years has really allowed a lot more investors to buy fractional shares, which is great for you guys starting out, because if you do want to buy a piece of Tesla or a piece of Apple or whatever, you can buy 0.3 or 0.05. If you have a dollar amount, you could buy $50 worth of Tesla, and it would give you that equivalent fractional amount of Tesla shares or Amazon shares or Microsoft or whatever other company you want to buy. So in terms of fractional, that's what it allows you, to work and to own and to invest in maybe specific companies or even ETFs with a lot lower capital without taking on leverage, without taking on debt. So that's effectively what fractional means. It's buying a share, a fraction of a share. So buying a piece of one share, because normally you would have to buy one share. I would caveat that in Singapore, you have to buy lots. In Singapore and in other markets like Hong Kong, you have to buy lots, and companies in Hong Kong decide their lot size. In Singapore, the lot size is 100. So if you're buying, say, I don't know, DBS, and it costs about $33 or so right now, that would cost, you have to buy 100 shares of DBS effectively. You can't buy fractional, you can't buy one. So 100 shares of DBS would cost you 3,300. So it's Singapore dollars, which is also, that's a decent whack of money. If you're talking about REITs, a lot of REITs are lower priced, so they're more accessible. So if you think about something like Maple Tree Logistics, for example, that's $1.76 or 77, something like that. So that 100 shares of that would only be 176. So it's a lot more accessible for you if you buy in lots in Singapore to buy REITs, because REITs they're generally lower priced, and you have to think about that. But I wouldn't worry too much if you're investing in the US and equating high price with it's scary or it's not accessible, because we shouldn't equate the share price with the quality of the business, right? The share price it just happens to be that share price. It's nothing to say that a REIT that has a lower share price than a DPS or OCBC is a worse business, right? So I think the mindset is more about the dollar value that you put into the stock or the ETF or whatever you're buying, and then think about the dollar value and how it can grow. But fractional allows you to buy more expensive stocks for a lot less capital, which is good. It's a good thing. Okay, that's the last question that we had. Thank you for your time and your questions. I hope that was, sort of more insightful on the long-term investing portion of it, and thinking about your journey and where you're going. And if there are any other sort of questions that you may have post this, please get in touch with us. I'd be happy to help answer any questions. So until next time, thank you for tuning in, and have a good evening. Thank you. Bye.